From the 30th Annual Morningstar Investment Conference in Chicago, I'm Jeff Patak, Global Director of Manager Research for Morningstar. I'm very pleased to be joined today by Jeremy Grantham. Jeremy is Chairman of the Board of GMO. Jeremy, welcome. Thank you again so much for participating
Nice to be
in
here.
this year's Morningstar Investment Conference. I wanted to start off maybe getting you to update your views on a commentary that you published in January of this year, describing some of the necessary preconditions of a possible melt-up, a scenario in which the market would rally very, very sharply and then perhaps fall precipitously afterward. Given some of the activity that we've seen in the market in the ensuing 4 or 5 months, where do you stand now?
The easy part of that is the bubble collapsing. Historically, in order to get the market to have a really major decline, 50% in a couple of years, you've needed to have plenty of air in the pricing, psychological energy. You need people to buy into some fairly preposterous thinking. It's revealed from hindsight anyway. So in 99, people believe it's a new golden era of the internet. Greenspan described the internet as driving away the dark clouds of ignorance. 1929, you had the same kind of euphoria. Without euphoria and crazy faith, without perfect fundamentals and an extrapolation that they'll go on forever, it's very hard to get a rapid decline of the kind that we had in 1929 and 2000, and to some extent in the housing market of 07 and 8. And so that's the easy part. In other words, we're probably not going to have a rapid decline unless we have a blow-off. A blow-off needs twice the rate of acceleration as normal, maintained for a little less than 2 years, like 21 months. And in other cycles, that has produced enough oomph to be about 60% or more. And it looked like we could do that, and certainly by the end of January, it looked very promising. By the end of January, it was rising so fast that if it had covered another 10 points, another 10%, by the end of March, it would have been up 60 in the final 21 months. And that would have only been 3150 on the S&P. If it moves slowly, that 60% target moves on up. So if it takes full 9 months, it was 3,400. If it took 18 months from last December, it was 3,700. And the chances of that happening are not as good today as they were back in December, January. And the reason is that the uncertainty that's being produced by the administration on important issues like global trade has served to constantly rattle and make nervous the investors. Unusually, this is balanced, on the other hand, by strong profit margins, by rising profit margins, the highest globally they have ever been, by a synchronized, reasonable global economy. So you have some good data on one hand, and you have some nerve-wracking input on the other. This is quite unusual to create a kind of nervous balance. So 1% forward, 1% back, 2% forward, 2% back. And in that environment, it's anathema, in terms of a bubble. A bubble needs crazy euphoria. This is not the environment in which it can happen. Now, I haven't written my 50% chance down below 35 or 30 for the following reason. If the midterms make the market relax a bit, we also are entering the sweet spot of the presidential cycle. From October of this year through May of next year is an incredible period of 7 months, which has averaged about 17% a year since 1932, since FDR. And that is our last best chance of having a bubble melt up. And when that passes, I think time is not on our side, and we will not do that. So what will happen? Where do the probabilities go that I take away from a bubble and a bust? They move to a relatively historically unusual format, which is bumping along. So you go down 15 and up 10, you go down 17 and up 13. You come back in 5 years and the market is down 15 or 20%. Profits are maybe up 10 or 15, and the PE's close enough for government work. And everyone always likes to think that's going to happen. It very seldom does happen. The market likes to go up a lot or down a lot in real life. But I do think with this kind of creative tension that we have, we may be able to pull that off.
What's an investor to do, given that outlook? I know there's a great deal of uncertainties that attend to it.
From GMO's point of view, our first choice is a melt up, jump out, and have it melt down rapidly and jump back in. Our second choice is the bump along, because we are out of the US equities, we're overweighted emerging and EFA, and there's nothing in my 5-year forecast that says S&P down 20 to prevent emerging being up 20. It's easily cheap enough to have that sort of divergence with room to spare, and maybe EFA up 5. And that is a dismal market for a pension fund, but it's not a dismal market for GMO's relative performance.